Generating reliable dividends is still a priority for many investors. And on today's show, we'll tell you about a recently launched active ETF that's focused on dividend growth. Plus, speaking of growth, stocks in the growth category continue delivering strong results. And we'll tell you about a pair of growth ETFs targeting large and small cap stocks. Lance McGray at Advisors Asset Management joins us right after this. Hello, welcome to the program. I'm Stephanie Stanton with ETF Guide. It is great to see you again. If you're new to ETF Guide TV, be sure to hit the subscribe button to join our community. Also, post your likes and comments in the comment section below. We enjoy interacting with all of our viewers. Well, joining us now is Lance McGray, head of ETF product at Advisors Asset Management. And Lance, welcome to the show. It is always great to have you.
Thanks for having me, Stephanie.
With interest rate cuts expected to begin in the fall, some investors still want to minimize the impact of rate changes while still keeping their dividend income steady. The AAM Low Duration Preferred and Income Securities ETF, and that ticker is PFLD, is one potential solution. Go ahead and tell us more about this, Lance.
Hi, Stephanie. Absolutely. As you mentioned, PFLD is really a unique solution. And in this environment, as interest rate cuts are expected in September, many investors, a lot of financial advisors are exploring or looking to extend their duration in their portfolio. And this is an area of focus for us here at AAM, specifically with our CIO team. And while they generally think that's a decent stance to be taking, we certainly urge that investors that we need to be very selective in terms of where we add that duration, where we extend that duration. And at the end of the day, it comes down to risk and reward, right? Where are you getting rewarded to extend that duration? And unfortunately, or in fact, some areas of the market, we don't believe that you're getting compensated for that additional interest rate risk. And we would say one area that we're kind of alluding to would be with preferred stocks. In fact, the yield being generated by low duration preferreds is actually, in fact, rate higher, in some instances, higher than the duration of a portfolio of longer duration preferred stock. So again, this is where PFLD comes into play. It is the first and only low duration preferred ETF currently in the market. So again, the way that we think about PFLD is really to gain the benefits of the preferred stock market, right? And what we're trying to do is get that high tax efficient income that investors seek when they invest in preferreds. They're looking for the added diversification, the capital appreciation, but we're also trying to minimize the two major risks associated with preferred stocks, and that's duration risk and call risk. So PFLD is a really interesting product right now, a product that's yielding over 6.5%, with a QDI over 70%, and the effective duration is 1.33 years, which is a 70% reduction in duration versus many of its peers in the marketplace. So a really interesting product, one that really kicks off a lot of yield, and one that can also protect investors from fairly large fluctuations in interest rates.
So AAM also recently added a pair of actively managed growth equity funds to its ETF lineup. And, it's a very exciting development. And the new funds are the AAM Sawgrass US Large Cap Quality Growth ETF. That ticker is SAWG, that's SAWG. And then you have the AAM Sawgrass US Small Cap Quality Growth ETF, and that ticker is SAWS, SAWS. So tell us more about the strategy behind these growth-focused ETFs and then what type of investors they might appeal to. Let's start with the large cap.
The great thing about these two solutions is the underlying strategies are inherently the same. One just focuses on large cap securities and the other focuses on small caps. And we can certainly dive into the strategies a little more, but I think what you mentioned in your intro in the question is really, really important. And I do want to note the significance of the trend that we are seeing in the adoption of active ETFs, right? So for many years, the success and to some extent, the identity of the ETF has really been tied to low-cost beta solutions, right? If we fast forward 30 years, investors are getting more educated. They are understanding that the ETF is not low cost or high cost or passive or active. They're understanding that the ETF is just a delivery mechanism. And for that reason, we're seeing a massive appetite for active ETFs, both from the sponsor side, right, the ETF issuer side, but more importantly, we're seeing the adoption from end users, institutional investors, retail investors, and that's something that we pay a lot of a very close attention to here at AAM. And that's something that, when we think about product development and product launch and offering the best possible solutions we can, it's just very hard to overlook the continued growth of active ETFs.
Absolutely. And we've seen that here on our show, on the NYSE as well. So breaking it down, beginning with your large cap, what kinds of companies might we see within that ETF? And then we'll move on to the small cap.
Well, in terms of the way that the team at Sawgrass, and maybe we should even start with Sawgrass and who Sawgrass is. Sawgrass is a firm that's 100% employee owned. They're based in Florida, and really they focus on quality growth strategies, and that's really at the core of what Saw G and Saw S offer. So when we talk about the philosophy, the investment philosophy of Sawgrass, they really believe that opportunities can be found by extracting value from enduring inefficiencies caused by investor behavior. And I know there's a lot in there. Probably an easier way to break this down is to look at what they're trying to accomplish. And what these strategies are trying to accomplish is looking for consistent, stable growth, number one, low price volatility, and three, attractive valuations, with the end goal being that these quality growth strategies deliver a predictable results across various market environments. And I think that's what's really appealing in these strategies. As we talk about growth strategies, everybody's talking about the Mag 7. But what happens when you look at, the companies that have the consistent and stable growth, the low price volatility, the attractive valuations, potentially as this bull market sort of broadens out, if you will, these types of strategies, investors may find very, very attractive because, again, they're not tied to the success of the Mag 7. And for that reason, these strategies are certainly ones that investors are appealing to.
Yeah, and that makes sense when you phrase it that way. In terms of the small cap, what type of investor might be more inclined to want to invest in SAW S or SAWs as opposed to the large cap?
Well, I think it's not necessarily large cap or small cap. It certainly comes down to diversification, creating a portfolio that's well diverse and can sort of handle whatever the markets throw at it. But I think in the small cap arena, it's certainly worth noting that these are active strategies. These are fully transparent, 100% active strategies. And that provides, the active manager a tremendous amount of flexibility to focus on certain securities. They're not tied to an index. And in this environment, the case can be made that this is the environment where you want or utilize active, really sound active managers, specifically in the small cap segment. And I think that's who it appeals to, is those looking for exposure in small caps and really looking for active managers that specialize in small cap investing.
And that makes so much sense. Moving over to dividends. So for dividend investors, the AAM Brentview Dividend Growth ETF, and that ticker is BDIV, was also recently launched. So tell us what's behind BDIV's unique dividend strategy, and then why is it something that advisors, investors might want to consider?
Yeah, so like SAW S and SAW G, the AAM Brentview Dividend Growth ETF, BDIV, is, again, it's a 100% transparent, actively managed ETF by a sub-advisor that has a tremendous track record in the specific investment style of dividend growth investing, and that's Brentview. Brentview has been in the market for over 25 years, and what's really differentiates Brentview from other managers is that they have a single focus, and that single focus is looking for dividend growth companies. And that is what they do. They do nothing else. And for that reason, we are super excited to partner with BrentView to create the AAM BrentView Dividend Growth ETF. And we think it's a strategy that will appeal to many investors, not only dividend investors. Listeners and watchers of this may wonder, well, there's so many dividend growth strategies out there. There's so many dividend strategies out there. What really separates BDIV from the pack? And I think it comes down to a few things. Number one, we know the active ETF space there are very few offerings out there. This is, again, it's a 100% actively managed solution. So that certainly separates it from the pack in terms of the traditional beta or rules-based indices. But again, this manager focuses purely on dividend growth. And I think the other one, if we want to get a little deeper into the actual strategy, what really separates BDIV from the rest is that the team at BrentView really expands its investable universe. And what I mean by that is a lot of rules-based indices that focus on dividend growth strategies have very hard cutoffs in terms of, a company has to have 10 consecutive years of dividend growth or 20 years of consecutive dividend growth. And that obviously excludes a lot of companies from their starting universe. The team at BrentView does not incorporate that view. And they are looking at companies that have either are going to initiate dividends or just initiate a dividend. So again, the universe of dividend paying stocks is much broader. And then you couple that with the active management of BrentView. And I really think that separates its, BDIV from many of the competitors in the dividend growth space.
Yeah. Now, a final question before you take off. You guys have another dividend ETF in your portfolio. It's the AAM S&P 500 High Dividend Value ETF, and that ticker is SPDV. So we're going to talk about that. But first, you talked about dividend growth. Besides dividend growth, what are some of the other challenges you see that are facing dividend income investors? And then second part of that question is, how might the ETF SPDV help?
Well, the first question around dividend investing, it really is a little more complicated than it sounds. Because I think many know that there's many different ways to take advantage of dividends, right? We just spoke about BDIV, and BDIV is really about looking for dividend paying companies that can grow those dividends, can compound those dividends, and really capitalize on that dividend growth without offering, a tremendous yield. For example, it's not going to be offering a tremendous a multiple on the S&P 500 dividend yield, but it really focuses on dividend sustainability and dividend growth. On the flip side, you have high yielding products, right? Those equity yielding products that may be appealing to those income-seeking investors that are looking either for diversification of income streams, the capital appreciation potential of equities along with dividend income. And so there's so many different areas of dividend-paying stocks. And I think that's one thing about our ETF lineup is we are trying to diversify our product lineup to align with all of those strategies because at the end of the day, as many investors know, diversification is key. And even within dividend-paying strategies or dividend investing strategies, it's really, quite honestly, it's beneficial to have exposure to many different dividend strategies. So I think that's worth noting. Touching upon some of the issues or some of the dilemmas that have been seen is, obviously as interest rates fall, investors may be looking for elevated levels of income. I think that appeals to higher yielding portfolios like an SPDV. But I think it's also important to focus on things like sector diversification. A lot of dividend-paying stocks, dividend-paying ETFs and funds out there are really concentrated in some sectors. So, focus on companies that are paying high dividends. In the instance of SPDV, we treat dividend yield and dividend sustainable equally, right? So we're looking at dividend yield and free cash flow. We have a tremendous sector diversification built into the rules, the underlying rules of the strategy. And also, it might be a really important time to focus on value securities, given the fact that they are so underpriced right now, and from a valuation standpoint, seem very, very attractive.
We are going to leave it there, Lance. Thank you so much. A lot of great information. We really appreciate your time. It's always great to have you.
Thanks for having me, Stephanie.
And to learn more about dividend income investing and ETF lineups at Advisors Asset Management, you can visit aamlive.com. The link is posted in the description section below. Also, don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs like this one, along with ETF Battles and many others. You can also find us on XFeed at ETF Guide. I'm Stephanie Stanton. Thank you so much for watching.